Okay, well, I think we should get started. Good afternoon, everyone. My name is Noor Kokiar, and I'm the Executive Director of the Washington State China Relations Council. I welcome you all to today's event, which is actually sponsored by our sister organization, the Washington State China Relations Fund. I'm pleased we are able to bring together two economists, both experts on global supply chain issues, to talk to us today. I had the pleasure of hearing the two of these gentlemen speak about 10 days ago, and I found their discussion very insightful. I'm really glad that they were willing to do it again and present it to our audience. There's no need for me to explain why we are producing a webinar on supply chain issues. The daily news feeds are constantly talking about the rise of inflation and how it is fed by bottlenecks in our distribution system. The number of ships backed up in LA has become a common talking point among everyday Americans. So we are all living with supply chain issues. I know that by the end of today's session, you'll have a much clearer understanding of these issues and appreciation for the complexities behind the problems. But before we start, let me briefly introduce our organizations, the Washington State China Relations Council and the Washington State China Relations Fund. The Council is the oldest state-level organization promoting bilateral commercial, educational, and cultural exchange with China. The Council produces thought-provoking webinars and other educational events, as well as providing information and policy suggestions to our government and business leaders. We have a sister organization, which is called the Washington State China Relations Fund, which is a 501c3 charitable nonprofit organization whose mission is to support the Council's educational programs and local community efforts. And now let me introduce our speakers. Our first speaker is Dr. Walter Kemmsies, is the managing partner of the Kemmsies Group, a consultancy providing services on freight movement, global trade, industrial real estate, infrastructure financing, and long-term strategic planning and capital investment. Dr. Kemmsies is viewed as one of the foremost experts on ports, rail, and infrastructure in the U.S. His areas of expertise include demand forecasting, maritime and overall global trade regulatory issues, public and private port and infrastructure financing, and long-term strategic planning and capital investment.
We're watching.
Walter currently advises several major U.S. port authorities. Please could I ask everybody to go on mute? Walter currently advises several major U.S. port authorities and is routinely asked to work on complex issues with various investment banks, private equity firms, and public regulatory agencies. For example, Walter recently testified to the U.S. Senate Transportation and Commerce Subcommittee on issues affecting the freight industry. Prior to forming the Kemmsies Group, Dr. Kemmsies was a managing director and senior director economist and chief strategist for JLL's U.S. Ports, Airports, and Global Infrastructure Group. He's also served in the past as the head of European strategy at JP Morgan in London, and earlier as the head of global industry strategy at UBS in Zurich and London. Our moderator today is Dr. Spencer Cohen, principal and founder of High Peak Strategy, an international trade and economics consulting firm based in Seattle. Prior to forming High Peaks, he served as a senior economist with Seattle-based econometric consulting firm. He's also held policy and research roles with the state of Washington. Spencer is a 2021-23 Public Intellectuals Program Fellow with the National Committee on U.S. China Relations, a 2021 Seattle World Affairs Council Fellow, and a Senior Fellow with Infinite Sum Modeling, an economics modeling and research firm whose clients include the World Bank, the Asia Development Bank, and various national governments. He's also an affiliate professor in the Department of Geography at the University of Washington. Dr. Cohen has a PhD in economic geography from the University of Washington and an MA in China Studies, also from UW. And his BA in mathematics and history is from the University of Connecticut. So before we get started, I have a few notes. Regarding housekeeping, please keep yourself on mute throughout the event. We're going to have time for Q&A before it's over. So please submit your questions in the chat box and we'll try and serve them up to our two panelists. Lastly, I'd like to note that this is our last webinar for 2021. This rates as our 24th webinar in this year's series. We hope you've all enjoyed participating in our events, that they've helped you to increase your understanding of the nuances of the U.S.-China relationship, and in particular, how they impact our state. And as a final comment, I'd always remind our audience that we make these events free of charge. We certainly would appreciate your financial support. You can do that by making a donation to the Washington State China Relations Fund at our website. And the website is very simple, just our initials, www.wscrf.org. So without further ado, I'd like to turn it over to Walter, and please would you start explaining these issues to our audience. Thank you, Walter. And you're on mute.
Nothing makes you feel old as much as Zoom when you mute it and you forget to unmute yourself. Good afternoon, everyone. It is, as always, it's an honor and a privilege to be able to discuss, big global trade and macroeconomic matters with your peers. And I appreciate the opportunity. One thing that Nora didn't know and couldn't have included in his intro, but Spencer and I have done some work in the Seattle area together, in particular supporting the Northwest Seaport Alliance in terms of understanding their national and regional economic impact. So we're not just two economists who can talk about things, we've actually been partners. So, and then he can tell you when he starts about, how horrible it was to work with me. So getting started here. Let me try to share my screen. This is always the hardest part of any presentation for me. Let's just screen one. Okay, good, share. And great. Yes. So far, so good. We're not there yet. I gave you the wrong screen to share. I beg your pardon. I never get this right. And I long asked HR to stop writing me up about it. Hold on one moment. Okay, stop share. You got to admit somebody. They're waiting to get in here. All right, so let's admit this guy. Good. Yep. Let's try it again. And we will share screen 2. All right, let's see if this works this time. Good. Do you see a whole PowerPoint?
No.
It says looking back and moving forward?
No, we don't see it.
Oh, good heavens. All right, we're going to go to plan B here. Just one more moment and we'll be good. And we'll do screen 1, share, do this. I hope you see looking back and moving forward.
Yes, we do.
Okay, great.
Right.
And
Walter, can you click the slideshow button? So
you mean the slideshow button?
Right.
No.
Yeah, that's not going to work. I have like 4 screens open and.
Actually, if you click it, I'll tell you how to show this the whole screen.
Okay.
And then so go to the left top corner, display settings.
Over here?
No, display settings next to it.
Okay.
And swap. There we go.
Oh, that's a good trick to know. Thank you. I got to write that down afterwards. Okay, so there we go. You can come up with a lot of clever titles, but the reality is we're economists, and we look backwards, see if there are any precedents, and then we kind of use that to figure out what's going to happen going forward. And so today, this is a particularly sarcastic title because if you look back, there are no precedents. So we actually have to think, as economists, we actually have to think for a change about what everything means and what happens, going forward. So there are a lot of things going on, and what I thought I'd do is just kind of keep it a little limited here, so that in terms of what we focus on, and then Spencer can direct the Q&A. We can get into all of the interesting issues that fall out of this. But I'm going to spend a little time looking at world trade, a little bit about the import and export patterns that we've seen. And then we're going to focus on, the root cause of a lot of the chaos. But basically, just in case you have to get off and you want to know what we're going to conclude, in the short term, basically what we're hoping is consumer spending on goods slows down by very early 2022, so we can sort out the transportation chaos. But the other things that could impact the ability to get out of that has to do with a union contract that has to be renegotiated next year, and it expires on June 30th. We'll come back to that. In the medium term, we are looking at the pattern of global trade changing because there is a desire to diversify import sourcing. Part of it is because of policy risks such as those imposed by both the U.S. and Chinese government, but also because of other risks such as demographic trends that are making it more difficult to just source in one country. Coronavirus has just augmented the momentum behind trying to change the patterns of global trade to be a little less risky. And then finally, we're going to talk about the long term because the transportation industry underneath all of this is trying to figure out how to get behind the consumer demand for environmental, social, and governance issues that seem to have not just mattered more during the coronavirus, but are really a major driver of not just consumer behavior, but corporate behavior. So those are the things we'll look at, and we'll get started. A lot of people have heard about ports. They know something about ports. And so I thought I'd start with a 3-minute Ports 101, just to get everybody on the same playing field. What you see here on the lower left are the volumes of 17 of the 21 largest U.S. ports. Some ports are landlord ports and some ports are operating ports. So Los Angeles, Long Beach, those are Seattle, Tacoma, those are landlord ports. And the East Coast is where you find the operating ports, and Savannah and Charleston would be good examples of those. When you look at the volumes of the ports, this blue line you see here are empty boxes going back to the countries where a lot of the imports come to the US. So you need to refill the boxes, bring them back. The green are the exports, and the red is imports. And you probably worked this out already. Import boxes are 50% of the total volume of boxes handled at the ports. If I just add up the import and export loaded boxes, that's this gray line. If I add the empties to that, I get to this black line. And the key thing you should see here is that there is a lot of seasonality in the container volumes. Since the container volumes are dominated by imports, and imports are primarily consumer goods. America did not outsource all manufacturing. It outsourced a lot of consumer manufacturing because it's cheaper to produce consumer goods in Asia, which has got the world's largest global middle class. And if you produce goods there, then you've got a cost basis whereby you can charge a price that the middle class can afford in Asia and still make a profit. So, I know it's very popular to talk about reshoring and how American companies should not have gone abroad and blah, blah, blah. Come on, get serious here. It's a global market, 7 billion people. This country only has 300 and some million. So you want to be able to sell to the global market, and you're going to move your factories to parts of the world where you have a cost basis that allows you to sell into most of the world market. So that's happened. It's not going to reverse. It's all about profits. It's not just about costs. So I'm sorry for people at the Reshore Institute and other such places. Take a hike. Okay. Let's focus here very seriously on large companies, the large markets, the large volumes. And but the work that I've seen done from reshoring institutes, and particularly from the one at University of Southern California, where they focus on companies that really have a supply chain that should be based in the US. And that's a whole different story. But telling me that a company like Nike should be reshoring, the math doesn't add up. So what happens then is, as we approach the fourth quarter holiday season with all of the nice holidays, beginning with Halloween all the way through Christmas and so forth, you have this big period in the third quarter of every year where a lot of boxes are imported so that you can empty them and put the goods on the shelves by the time you get to roughly Black Friday. And so there's a lot of seasonality. And what you should notice here is that in 2020, we had a huge surge in volumes. It was driven by imports. We've never had such a large level of volume of imports. And this volume of imports has stayed roughly at this level for the last 14 months. So the main ports that import these things, Los Angeles, Long Beach, New York, New Jersey, Savannah, Seattle, Tacoma, they fell a little bit in the rankings because of a lot of sailing cancellations, but nonetheless, these four corner ports, so you can see them here in the map, they're the four, normally the largest gateway ports. They handled and continue to handle peak season volumes since August of 2020. They have not had a break. Now, you know, in my industry, where we advise on capacity development, we always say you don't build a church for Easter Sunday. Well, it's been Easter Sunday every day for 14 months. And that's fundamentally what lies underneath the issues with the ports. Now, let's take a step back and look at it from a global perspective before we go back and take a look at the US. By the way, these slides, they're available. If you need a copy, you can, you know, email Man or Spencer, me, or anybody. We're happy to give you a copy of them. So let's go to world trade and manufacturing trends. This data comes from CPB. It's an institute in the Netherlands, an economics institute, excellent work. And I like the fact that they make their data freely available, because I like data where people can check me out and make sure that what I said and the data are actually the same. So we look at the CPB data, and basically they do track world trade and they track industrial production. And what we see is that back in the 2008 to 2010 near depression experience, or also called the Great Recession, we fell off a cliff. We took the world down with us in the US, and then some of the other countries that didn't do the same things that the US did, they didn't have this problem, but China was also impacted. And during this period, China built a lot of infrastructure so as to keep everybody busy. In the US, it took years to get back to where the trade levels were, as well as for industrial production, years to get back to where we were. So that's the most recent experience. That was a supply side recession, not a demand side recession. Was engineered by the Fed, who inadvertently made the same mistake that it did in 1929. And so when we come to the coronavirus period and we fall off a cliff a lot faster, every politician was afraid of losing their job. And so they were all happy to vote for trillions of dollars of stimulus spending. And we had world trade pick up a lot, driven by the US, and we'll see in a minute how much. And industrial production also picked up. And basically, instead of 3 to 4 years to get back to where we were, it happened in 7 months. And so I was unfortunate. We had a lot of management consultants out there telling companies, early retire your people. We're never going to fly again. We're never going to go out to restaurants. We're not going to shop in stores. And so a lot of mistakes were made. The US economy's ability to produce stuff, the world's ability to support world trade at previous levels, was undermined pretty badly. And so we did have this bounce back, but it did come at a cost. So let's look at the US case in particular, because it's an interesting, it's interesting what happened in the US, and the data is a little more transparent for identifying the source of the problem. So what could that be? Before I do that, I do want to just point out here that imports and export trends. So these are exports, these are the imports, and you get this pattern of red meaning down and green meaning up over the previous 12 months. And you have a lot of mixture of red and green, which means many countries were shutting down and reopening, and then shutting down and reopening, just like the US did, or regions of the US did. And this created a terrible supply side problem. But the bigger problem was the demand surge in the US. So I really want to focus on this for a little bit. As an economist, I have to worry about retail sales, but when it comes to ports, I don't care about retail sales. I care about retailer sales. It's Amazon, Walmart, Target, Home Depot, Lowe's, these really large retailers. Most of the stuff they sell is imported from other countries. And it's their sales that I care about, because when they sell more, they import more. and that comes through the ports that I work with and I'm privileged to advise. And so this red line here is the sales, retailer sales. This is, seasonally adjusted data. If you don't seasonally adjust it, it kind of looks like the port data that I showed you earlier, but you still see the very same pattern that first we fell off a cliff as the economy shut down. And then as the economy reopened and we gave people stimulus money, the retailer sales, these big retailers didn't really close their stores. And they also have excellent e-commerce platforms. So the sales surged on the back of that. And some of the spending was because people needed to fix up their homes so they could work from home, school from home, spend more time at home, do other activities where they were socially distanced. And then some of it was, probably, just silly spending. But the bottom line is that the sales rose and rose and rose, and they've been running well over 20% higher than what they were at their previous peak level value for the same month going back in time. If I were to forecast retailer sales in 2019, I would have said they would have reached this level of 575 billion or so per month by the year 2030, maybe 2033, right? Retailer sales growing 2 to 3% a year. Here they jump 20%. Divide 20% by 2 to 3%, you get 10 years, maybe 6 or 7 years. So that's how far ahead the sales are. What happened to inventories? Well, the inventories fell off a cliff. And as the retailers have tried very hard to rebuild their inventories, they haven't been able to. As soon as they get stuff on the shelves, it gets sold. And that's what you see between the red and the blue line here. We've all had this experience. You go to the store one week, this side of the shelves is full, that one's empty. The next week, it's the opposite picture. And the way you measure this is to look at the inventory to sales ratio. And the inventory to sales ratio, which had been running around $1.45 of inventories to $1.50 per dollar of sales, has dropped to just about $1.10. And so that $1.10 of inventory to sales ratio was why you see this, continuously in your stores, whether it's clothing stores or grocery stores or whatever. It's just too difficult to rebuild the inventories. And if you look at the, not seasonally adjusted data, the way the chart looks like this. And so this is what's happening to the ports. They're struggling to meet the holiday sales demand from consumers who started buying early because every logistics expert out there told us we wouldn't be able to buy stuff at Christmas time. So people started buying early. The retailers have been trying to rebuild their inventory. And then, of course, with all that stimulus money, they were buying, over and above what they normally would. And all of this stuff gets here through the ports. And that's what's happened to the ports. Now, let's take a close look at, the ports that have got the most attention. And that would be the ports of Los Angeles and Long Beach, down in Southern California. How do we put this? When you look at this chart here, this goes through, I think, March of 2021. Those ports, LA, Long Beach, have been handling peak level volumes for the last 14 months. The only 1 month were the volumes lower than a previous peak, and that would have been late 2018 when Donald Trump threatened to impose tariffs on imports from China. With that one exception, every month in the last 14 months have basically been above previous peak levels. Normally what happens is you hit November, December, January, the volumes drop, and that gives the ports the ability to clean the deck a little bit. The extra empty boxes sitting around are given to the exporters. You fill them with stuff. The exports go back to Asia. Then you hit, you start getting close to the Chinese Lunar New Year. And we know the country's going to shut down for, somewhere between 1 and 3 weeks. So you rush to get anything out of China that you need because the ocean carriers are going to start to cancel their sailings to the US. And then afterwards, it's kind of quiet until we start getting ready for the next peak season. So we didn't get that recently. As the ships arrived in LA Long Beach. There are 26 berths at 13 terminals that you can call it. The left-hand side here, which is the west and north, is Los Angeles. The east and the south side is Long Beach. This is from marinetraffic.com. I just took a picture of what the screen looked like. And just a couple of weeks ago, these were all the ships sitting within 40 miles of the terminals at LA Long Beach. So these ships have a problem. These ships arrive at the port. The port is so full of containers that it takes a while to unload the ships and put the boxes someplace where it doesn't impact the ships. And then the drivers need to come pick up the containers at these terminals and drive them to the warehouses and distribution centers in the area, or else you put the containers on a train and you send them to places like Denver, Dallas, St. Louis, Memphis, Chicago, where the products are then redistributed. So the problem is that there weren't enough rail workers. A lot of them got early retired. And so we ended up with miles of rail cars waiting to get into the rail yards. At the ports, we couldn't get a lot of the boxes out of the port because the distribution centers were absolutely full. Very, very chaotic. The problem is there aren't enough warehouse spaces or warehouses to lease beyond what we have right now. The vacancy rate in the industrial real estate market in most port cities is below 1%. So there's no other place to get, to rent. And so some of the companies started to rent trailers. Others just took the containers on chassis and parked them in their parking lot, which then created a new problem for the ports because the ports have, in this case, LA Long Beach, 19 million containers to handle, and they've got 1 million chassis to deal with it. So they need those chassis to keep coming back to the port to pick up a box, take it out, pick up a box at a distribution center, bring it back. And so when the chassis get tied up being parked all over the place, it gets more and more difficult to handle the ports, to handle the volumes at the ports. But the real issue for the ports is basically that there is a truck driver shortage in this country. So when we look at the ports, there's two kinds of drivers. There's the drayage drivers. And the drayage drivers, they basically pick up stuff at the port and they take it to the distribution center. And then you have the over-the-road, the OTR, the long-haul truck drivers who will drive stuff more than 250 miles away from the port. And their job is basically involves them having to sleep on the road. They get 11 hours of service. Once their electronic logging device says they've done all the driving hours they can, they have to pull over wherever it is, maybe a place that has no bathroom, no retail, no nothing. And they get to sleep there or hang out there until the electronic logging device says they're allowed to drive again. It's not a great job. The American Truck Association says that, American Trucking Association says we have an 80,000 truck driver shortage, and it's only going to get worse. We're looking at north of 250,000 long-haul drivers shortage in 10 years. So with that problem, it becomes difficult to get stuff out of the warehouses and distribution centers at the ports and take it inland. So you can have simultaneously excess inventory at the port cities and nationally a shortage of inventory. And that's the way it looks. And it's driven by supply being a little erratic because different countries, different areas open and close at different times because of the waves of the pandemic. We have excessive demand, particularly stimulated by U.S. governments, handing money to the U.S. consumer. And then, of course, the transportation industry was already short truck drivers, at least in the U.S. it was. And we cannot grow the transportation industry's capacity by 20% overnight. It just doesn't work that way. It's a whole supply chain. So that's why we are in a bit of a crisis. And, the Ocean Shipping Reform Act has a few minor interesting things in it, but most of all, it's just not going to solve this problem or help very much. Those are just the simple facts. One of the things it asks for is to balance the trade between any two countries. And any economist will tell you that bilateral balanced trade is not likely, nor does it make sense to focus on. It's all about multilateral trade. So, the problem will continue until at least the second quarter of next year. So let's look to the long term a little bit here. And one thing we know is that U.S. imports, the largest share of U.S. imports come from China. China's share has been declining. It peaked in 2018 as Trump threatened with the tariffs. And then it dropped in 2019, 2020, and then this year it's also lower. And this isn't something that happened overnight. It was actually a trend that was brewing since at least 2016. The reason for that is China's working age population is shrinking. And it's been shrinking for 5 years. So the lower value products that were produced in China start migrating out of China to places where you can get cheaper labor. Basic economic principle. So we've seen that happening, but between 2018 and 2019, you can really see the effect of what happened by looking at the volumes at U.S. ports. So the West Coast ports shown here on the left had lower volumes in 2019 compared to 2018. The only one who escaped that fate was Oakland. And what Oakland had done is reconnected itself to parts further to the west in Asia. Because as things moved out of China, they moved to Vietnam, they moved to India, they moved to Indonesia. And in those countries, their share of U.S. imports went up. And when they export products to the U.S., it goes to the U.S. via the Suez Canal and not via the Pacific to the West Coast or Pacific to the Panama Canal and then the East Coast. And so we see that the East Coast ports all gain share from that shift in the sourcing. This will continue. U.S. and China can sit down together and renegotiate trade agreements. They can become great friends. They can become big enemies. It doesn't matter. The economics are against China maintaining its share of U.S. imports. The working age population is shrinking. I have friends in China who manage factories and they're having trouble finding workers. And in fact, a lot of the young workers don't really want those factory jobs anyways. There's a cultural thing that's been arising in China called laid back. And the workers prefer to work a temporary job for a few days and then go hang out at the park for a few days. They don't want to eat, sleep, and work in the same place. They're different than their parents' generation. So I cannot find a reason to argue that China's share of U.S. imports are going to go back up. They're going to go down. That's all I can tell you based on the economic trends. So let's focus a little bit on the consumer before I have to be quiet and give Spencer a chance to speak up. I'm very focused on the new consumer profile. Always have to be. Consumer drives everything. ESG is very, very important. And what we're seeing from the new consumer, the younger consumers, because we look at the young folks, they're the ones who buy things. The older folks like me, we're the ones who have garage sales. So, the young guys go to Walmart sales, and I have a garage sale. And what we are seeing is interest in meatless meat. Why meatless meat? That's because it's made from plants, and plants help reduce the global warming trends by pulling carbon out of the atmosphere. Clothing. What's the most popular clothing retail outlet for those under 30? It's Goodwill, or if you're in the UK, Oxfam. Basically, recycled clothing is seeing increased demand. That's those folks. Now, why that matters so much to me is because the retailers, the traditional retailers like Walmart, Target, Amazon, and others, they're asking all of their transportation and service providers to monitor and report on how much carbon they're emitting in doing and getting that product to the shelf. They would like to put a price tag on the shelf that says the product costs so many dollars and so many pounds of carbon into the atmosphere. And this is not good for China because China has a reputation for not really caring for the environment very much. Now, recently, there have been statements about a reversal in the policy, want to get the air cleaner, et cetera. But, the reputation is still there that it is one of the world's largest polluters next to the United States. So that does not bode well for trade with China. Another thing that is really picking up is it's all about e-commerce, but that's a different problem. Nonetheless, what we are seeing is that there is a need to resolve logistics in a way that we can sustain increased growth in e-commerce. So I'll stop here. I'm going to skip the inflation thing. I hit the time limit, but I just want to point out that we've had big jumps in consumer price index. It's being blamed on the shipping industry, and that's nonsense. Yeah, the container rates have gone up some, but they're not at $30,000 like some of the media like to say. That's a spot market rate for a small number of boxes. The vast majority of containers that come into this country are done under contract, and those rates are running somewhere between $3,000 and about $7,000 per 40-foot container these days. It's not $30,000 for every single box coming into this country. So what we are seeing is that companies are finally beginning to pass on their cost increases to consumers, and that's what we saw in the most recent CPI data. So just to stop here, I'm hoping to see consumer spending slow down so that by the first half of next year, the second quarter, we would have much less chaos in the shipping industry. Unfortunately, the ILWU, that's the stevedore union for the whole West Coast, their contract with all of the terminals on the West Coast comes to an end June 30th. And if it gets acrimonious, as it did in 2015, we could see a number of boxes or containers shifting to the East Coast and a lot of the same chaos that we saw in 2015 and during a good chunk of the pandemic. So hopefully the contract is renewed or extended and we can get past this current chaos, but we have to watch out for that. So looking medium term, we see global trade patterns shifting, to becoming a little more globalized rather than so concentrated on China. And amongst other things, it is also driven by a desire to diversify import sourcing and reduce supply chain risk. And then long term, what I do hear from the transportation industry is, how do we get behind the consumer demand for ESG? I've seen the data, and the younger consumers are willing to pay for a healthier environment. So these are the things driving the industry from my perspective at this point in time. And let me stop here, Spencer. Let me pass it on to you.
Well, thank you, Walter, for such a, there's an echo. There we go. Thank you, Walter, for as always, such a rich and enlightening and incredibly informative discussion. I have a few questions that I'd like to pose to you and have you help us better understand, and then we'll turn it over to the audience for Q&A. My first question is about the announcement in November that the Biden administration had reached a deal with the Port of Long Beach, or so it's LA actually, Port of LA, and expanding operations to 24/7. Can you help us understand what that actually means? Because it doesn't seem to have had a big effect on port volume that's being handled, nor has it actually resulted in more hours being actually being worked by the longshoremen and other operations there. So can you help us understand what exactly is within the powers of the executive branch to expand operation hours, and what are the limits, and help us understand what that actually means, that announcement?
It's a really good question, and you're right. It's more of a facade than anything else. There are 13 terminals in the Los Angeles Long Beach Port Authorities. All of those terminals are operated by the private sector. The two port authorities are landlord ports, and they have no more ability to make those terminals operate 24/7 than I do. There's a lease. There are companies like SSA that's headquartered in Seattle, and they decide what hours they're going to work. And you can cajole them, you can yell at them, you can scream, but in the end, it's their decision. So when that announcement was made, I think a total of 4 terminals between LA and Long Beach had signed up to operate 24/7. And the problem is the truck drivers didn't show up. And the reason they didn't show up is because if they picked up containers and went to the warehouses, they'd have to sit there until the warehouses opened the next morning because they were closed. The reason they were closed is no place to put anything. So the drivers didn't show up at the ports because they had no place to take the boxes to. And so it hasn't really made an impact. You know, as I was indicating earlier, if you wanted to make an impact, you would have gone to the military and said, we're going to furlough all the truck drivers, and we'll allow those truck drivers to drive boxes, you know, either from the port, dray them from the port to the DC, or else just long haul them.
Oh, you're on mute.
How'd that happen? Yeah. Anyway, so that would have been a much better option, because, you know, it's like the pig and the python, right? Or the rat and the python, whatever the animal is. And so it's got to be an exit strategy here.
What about, so you were drawing a distinction between typically a West Coast port that is a landlord port versus an operator-owned port on the East Coast. And that's not a perfect distinction, but it's generally right between West Coast and East Coast. What implications do those different structures have in terms of the port's ability to invest in infrastructure, to expand capacity, and also just their operations? You mentioned as well, like, you know, with this, the 24/7 announcement, it didn't have a lot of teeth because they're privately owned terminals. But what are the, can you help us understand a little more about that distinction between, and what the implications are between a public, you know, a landlord port versus an operator port?
Right. So Houston, Savannah, Charleston, Wilmington, North Carolina, they're operator ports. So they can make a decision about how they want the port to work, and they can enforce it. But if you're in New York, or if you're Oakland, you can wish for the terminal operators to operate a certain way, but you can't force them to, unless you've got something in the lease. And I've read many of these leases. There's nothing in the lease that says the terminal operator has to do what the Port Authority tells them to do. But there's another distinction too. The West Coast ports tend to be joint ventures between an Asian ocean carrier and a U.S. terminal operator, so they operate jointly. And the ocean carriers have for many years, you know, always motivated importers to use the West Coast ports, because you get to pay them to haul the box on their ship, and then you get to pay them for operating the terminal. Whereas on the East Coast, that's generally not as much the case. I mean, yes, it is a little bit, but not as much as in the West Coast.
Another question was about port capacity. And you talked a lot about the fragilities. We have this sort of like exogenous shock or series of exogenous shocks, beginning with COVID, beginning with factory closures overseas. We also had the various rounds, trillions of dollars in stimulus spending. The vast majority of that is being spent in very kind of accelerated ways among many households, and primarily more so on physical goods than on services. So we're seeing a big increase in spending that's really kind of like rock the system, so to speak. But prior to the pandemic, there were already, as you identified and discussed, some existing fragilities having to do with labor, and specifically with long haul truck drivers. You mentioned the 80,000 truck driver shortage, and that's projected to grow to 250 in 10 years. Can you talk a little more about what other, maybe not as important as the truck driver shortage, but are there other kinds of fragilities, such as rail capacity, such as just built infrastructure, such as warehouse capacity, that is going to continue to kind of bedevil our ability to get out of this in the long run, these bottlenecks?
Yeah, so let me start with your last point. With the warehouses, there is a surging demand for distribution center and warehouse space, particularly near the ports. The reason for this is because if you shift from retail sales at bricks and mortar stores towards e-commerce, you now need more square feet of distribution centers and warehouses to support those e-commerce sales, because you don't have that space in the store to store stuff on the shelf, and in the back of the store in the little storage room, that's all gone. So you need to build new storage space in distribution centers and warehouses. Mm-hmm. So this is fueling tremendous demand for industrial real estate across the country, but in particular around the ports. Because basically, if you're going to, it's not that hard to forecast how much you're going to sell. And you and I know this. We've had to do that kind of work before. But forecasting where it's going to be delivered, that's a different matter. Okay, I mean, I can forecast I'm going to sell, 10,000 cross pens in the next year. Great. Where? I don't know. I have a nephew who's graduating from high school next year. I'll buy him a nice pen. There's no AI in the world that's going to predict that that's what I'm going to do. So when you bring stuff into the country, or if you get stuff from factories in the US, where should you keep it if you're an e-commerce or retailer? And the answer is next to the source. Don't move it. If it comes in at a port, leave it at the port. And then what happens is you don't end up moving the product 2 or 3 times. So for example, if it's lawn chairs, it's going to be a hot summer. The northerners will come out and the southerners will stay indoors. So, you're going to sell and deliver your lawn chairs in the north. If it's a cool summer, the southerners will come out and the northerners will stay indoors. Once a summer with 50-degree weather at 6 p.m., right? Not fun. So when I bring my wheelchairs into the country, where should I put them? In the middle of the country, in the north, in the south? Just leave it at the port. Just leave it there. And then once you see where the sales are occurring, you only have to move that chair one more time. And that's part of what's going on is this geographic imbalance that you're seeing because you want to keep stuff near the point of origin. And we just don't have an awful lot of our transportation labor sufficiently concentrated in those places.
So I have 2 more questions briefly, and I want to turn over to the audience. But given that this is the China Relations Council, there's going to be a lot of people, I'm sure, with questions related to U.S. China relations. And you did talk quite a bit about it, but I just wanted to kind of poke and prod and ask you to go a little deeper. We've seen a lot of trends as you've highlighted over the last couple of years, beginning with the trade war, actually with the trade war, but even preceding that, 10 years ago even, started to see wage costs go up in China because of a reduction and eventually exhausting of that surplus rural labor that was working in the factories, as well as also cultural shift as well. That's really diverted a lot of labor away from manufacturing or potential labor. So you've seen wage costs go up. You've also seen a growing tension or aggravated increased tension between the US and China. And you've seen new policy frameworks such as with dual circulation, and which puts a lot of emphasis on China's own sort of autonomy and investments in what they see as supply chain vulnerabilities, as well as the US putting more constraints on constraints on US companies being able to purchase various types of technologies or sell to even to Chinese counterparts and do business. So thinking more broadly, you had mentioned about this idea of diversifying of trade. And wondering, one of the advantages China still has, I think, is that it has the economies of scale and the infrastructure. But where do you see, especially for manufacturers that are not, that are in China now, but are not selling or not focused on the Chinese domestic market for part of that output and do rely on low-cost labor, where do you see that going? Do you see, and what implications is that going to have for the Pacific Northwest? Because the Northwest, at least the Northwest CIPRA Alliance, there's roughly about 100,000 jobs in the state that are associated in some way with trade. So any loss of that trade with China is going to have a big impact on wealth generation in the region. So do you see, for instance, like Vietnam becoming a bigger player? Do you see even Latin America potentially becoming a big player in manufacturing? Places like Mexico? Maybe if you could just elaborate and prognosticate a little more about where you see that, any sort of big changes in supply chains in the long run.
That's a long question, Spencer.
Sorry, that wasn't a short question. Nor can you provide a short answer, I'm sure.
Well, the one thing is China has not only economies of scale, but economies of scope. And so, if you look at many countries, or even in the US, I'm helping a lot of small companies pull out of the West Coast and the Northeast and move to the Southeast because they just can't afford the labor, the expensive transportation, they can't afford the real estate, and the Southeast is still cheap on all 3 counts. And a lot of these companies are smaller. The problem is if you pull out of New York and you want to move to a Southeast port, you have to be careful because not all Southeast ports have 3PLs and other logistics support that span the breadth of all of the industries that are supported in major ports like New York and Los Angeles, Long Beach, Seattle, Tacoma, for that matter. So it's the same thing with countries. If you want to pull the underwear industry out of China, that's not that bad. In fact, it tends to concentrate now in Costa Rica, Nicaragua, El Salvador. That's great. Can they help pull the computer industry out of China? No. It's a very broad industry. There's a lot of, forget the manufacturing aspect of it, just the logistics support alone is a very different art form than the logistics support for, underwear. I exaggerate a little bit, but you get the idea. And so China has incredible economies of scope and scale to support all of that. Unfortunately, it just doesn't have the people or the population growth to continue to support all of that going forward. That's what we see declining. The problem is as you leave China, your options, you don't want to go to Japan or Korea because they're also expensive. And unfortunately, when you go to the rest of Asia, the infrastructure, let me use a technical term here, sucks. It's congested.
We always count on you for the appropriate technical term. So
exactly. So you go to South America, you go to Central America, and it's the same great quality infrastructure you find in Vietnam and India and other places. So all of those countries, India in particular, has the Sagarmala policy where they plan to put billions into their ports, and they have been, but there's a long ways to go. So it's not that easy to pull out of China. China is a class act. It is a global manufacturing powerhouse. I think it supplies 60% of manufactured goods to the world economy. So trying to pull that out of there is, as the French say, bon chance, good luck. Anyways, that's a short answer to your question.
It's more of maybe it requires a dissertation for a full response, but that was a great short answer. I know we have just a few minutes left, so I want to be respectful of the audience. And Nor, do you want to take over and submit some questions from the audience to Walter?
Yeah, I'd be glad.
Sorry, man, there was a question here from a gentleman, Timothy McClelland, and I could take just 30 seconds to answer that. We do have a few automated terminals in the U.S. There's one in Norfolk, Virginia, and there's one in L.A. There's one in Long Beach, LBCT, Long Beach Container Terminal. I actually worked in that one years ago. They are automated, and there is increasing pressure on U.S. ports to automate. Most of it, people say, is because automated terminals are more productive, which it's a nice story, but it's not true. East Coast ports are able to get the same number of moves per hour, et cetera, that you do at automated terminals in other parts of the country. The difference is that with automated ports, you get rid of the labor problem. Labor doesn't want to cooperate, then you don't have any alternative. Whereas if you have machines, you just tell the machines what to do. Does the U.S. need to automate more? Yes, I believe so. The volumes are growing. There are other opportunities for port labor to continue to add value rather than just stand there underneath the container cranes. And it's time to move the conversation in that direction and, not be afraid of automation. We are having trouble finding more stevedores, finding more people to train. It's not just truck drivers, but railroad workers, port workers, et cetera. There's a labor shortage in this country. So yeah, Mr. McClellan, I completely agree. We need to push hard in that direction.
Yeah, and Walter, there was a question just as you're talking about, what would it take to get more stevedores, more truck drivers, et cetera? Is it just higher wages, or is it there just isn't enough supply of people?
Honestly, I think that we should allow the companies that provide these services to add more technology to make the jobs a little more, interesting, comfortable, and palatable. When you look at autonomous trucks, we're not going to let trucks, 80 to 110,000 pound vehicles go around our country and, with the potential for accidents, especially if it's hazardous chemicals. That just doesn't make sense. But what we can do and what we have done is let the truck driver get the truck onto an interstate where it's a relatively controlled environment. And then the driver jumps in the back seat, which suspends his hours of service or her hours of service until they need to get the truck off the highway. And then they jump into the front seat and the hours of service resume. This way you could get a lot more miles per driver in a very safe manner. And so these are the kinds of things that we would be looking for.
Great, good. Glenn, you have your hand up, but do you have a question you want to ask? And if so, please take yourself off mute. Here we go.
Yeah, I do. So, hi, Walter. Glenn Bachman. I'm the commissioner of Port of Everett. And we're experiencing where Amazon, Walmart, FedEx, Schneider, all of the bigs are chartering whole ships and bringing them directly to Everett and to the Port of Houston. And Amazon recently sort of bragged about that, but also the FTC is looking into what it is they're doing to keep their shelves full, and is it unfair to the small merchants and retailers? So your thoughts on that?
Yeah, years ago, we saw a couple of the larger retailers consider chartering vessels and doing just that. Amazon does have a license to be an NVOCC, that's a non-vessel operator container carrier. So it actually is a license to do that. These smaller guys, smaller, let's say medium-sized companies, I know a coalition of them have banded together, and they engaged in pooled distribution. So essentially, since none of them are big enough to be able to get the scale to compete with the biggest retailers, Amazon and Walmart, they then pool together 6 or 7 of them, and then they have enough volume to be able to spread the logistics costs across a large number of products, and therefore remain able to price competitively. And you see this a lot in the agricultural industry. Companies like Sunmade are basically a cooperative of farmers. So what you need to see at the smaller business, smaller company size level is more cooperation so that they can spread their costs over a greater volume. And if they don't do that, and there's some legal reason they can't, then in that case, for sure, they're being slighted. But let's go back to your key point about chartering these vessels. It looks a lot easier to do than it is to execute. And so I know quite a few companies that chartered vessels and feel that it was a very, very bad idea. It didn't work that well for them. Now, those tend to be companies that went to the normal big ports. I don't know what their experience was when they went to places like Everett or Wilmington, North Carolina, or Wilmington, Delaware. That may have been a different outcome. But trying to squeeze a 2,000 container vessel into the ports of LA or Long Beach is just not a good idea. You have to prioritize the larger vessels and get them in and out. So, the math works against that if you go to a big port.
That's actually an advantage for Everett, because I have a friend who's chartered a small container ship for a company here, and that's exactly where they're going to take it.
Yeah, that works. That makes perfect sense to me. But trying to send it into, Los Angeles, the largest container port by volume, I don't think so. No, it's not the right thing to do.
Right. Okay, so we're up at the 5 o'clock PST, which is our official closing time. Walter, are you willing to take a few more questions?
Yeah, I can do a question or two, because we're hitting cocktail hour here.
Okay, all right, yeah. Walter's on the East Coast, so it's cocktail time. So, Will, do you want to unmute yourself and ask your question?
Unmute. Okay, yeah, can you hear me?
Yes.
Yes.
All right, so just now you were talking about using, about Groupon for container ships, I guess.
I like that.
Yeah. So we're talking about you're just talking about smaller ships, and we've been hearing that that because of problems in Guangdong province for smaller feeder ports, going out to the larger, smaller ships from smaller feeder ports, taking containers out to larger ships at sea, prepping them for the Pacific crossing to the U.S. They're going to be shutting down for 5 to 6 weeks during the Chinese New Year time, when they had originally scheduled 2 to 3 weeks. So if if there's a shutdown on the Chinese side and they're canceling, and that they're canceling shipments now, starting to cancel shipments now. Have you heard this? And what would happen if, you know, if the source sending stuff over was closed for 2 or 3 weeks longer in February? What would sort of be the, what would be the domino effects after that?
Yeah, actually, I have heard this, and it's, yeah, you're right. The smaller operations, smaller companies, those are the ones that are announcing that they're going to suspend services for, you know, a longer time than usual. What happened last year is, you know, obviously when you try to reopen China, nobody could travel because there were travel restrictions imposed due to the need to shelter in place due to coronavirus. So it's not very clear what will happen. You know, the workers will try to go home, the truck drivers will try to go home, and whether or not they are willing and or if they are able to come back is a big question mark. So it makes sense to, you know, basically under promise and over deliver. And I think that's basically what you're going to see happen. But having said that, though, China did build in many cities temporary coronavirus hospitals in fear of surges of coronavirus cases during the colder winter months. So everything is up in the air. I think in the end, they are going to not be closed down as long, and they will be able to operate better than they did a year ago. You know, it's one thing to get hit by surprise, and it's another to see what's going on, prepare yourself, and then get hit as if you were, you know, as if it was a big surprise.
Well, Walter, I guess I would like to know is what's your thought on the U.S. consumer, because this is what's driving all this. Do we think after this Christmas holiday we'll get a drop off in demand? You know, people will finally say, "I can't buy too much stuff." What's your thought on that?
Yeah, that's kind of my bet. Although I did notice in the last few months that people were spending more on going out and on goods than they were before. I thought there'd be some kind of substitution, you know, that you'd start, okay, let's go out more and let's stop buying all of this stuff. But that's not the case. But having said that, when I break down the volumes for the ports, and I find this very disconcerting, for the 10 largest gateway ports, the proportion of their goods that I think are being imported to support residential real estate is higher now than it was before, much higher now, and that share continues to grow. You know, so I'm watching the housing industry very carefully. We are building a lot of new houses still, despite higher commodity prices, and a lot of the stuff that goes into a house is imported. You know, the flooring, the tiles, the appliances, you know, the sheetrock. A lot of this stuff comes from other countries. It comes in containers, and I'm seeing that in the data. And I wonder if the Fed's hand is going to get, you know, forced a little bit to have to raise interest rates quite a bit, and that would, you know, kill the momentum for the housing industry and therefore impact the ports. So to me, that's the segment that really you have to watch when it comes to buying the goods and how that impacts the shipping industry.
Good. Thank you. We've had, okay, we're down to like 3 or 4 more minutes. A gentleman named Tony asked a couple questions. One, he asked, what are the pros and cons of OSRA, OSRA 21? And you'd have to explain that to us because I don't know exactly what that is. But
yeah, that's the Ocean Shipping Reform Act that got passed by the House. It's got 6 or 7 points to it. A couple of them are traditional stuff that economists, whether you're a liberal economist, a conservative economist, a market economist, you know, is nonsense. So trying to balance trade bilaterally with every country doesn't make sense. You know, it's natural for the U.S. to run a surplus with the Middle East countries and to run a deficit with the Asian countries. Now, how much of a deficit and surplus, that can be debated, but trying to make sure U.S. trade balances with every other country out there is just no. What it should focus on is fair trade practices. But one of the things that this act has is a big change in how detention and demurrage occurs. So what happens now is I bring my product into the US, it goes into a US port. I need to get my truck driver to go into the port to pick up my container and take it out. And if my driver shows up and he can't even get into the terminal because the line is so long and the terminal operates so slow, the next day I get a little bill, an automatic bill, and I get charged a day of demurrage. And the demurrage charges increase the longer your product sits there. And so the next day I send a truck driver in, and if the truck driver can't get in the port, then I get, yesterday's bill if I hadn't paid it yet, and another bill for today. The OSRA reverses that. It says, you know what? It's not the importer's job or the exporter's job to prove that they made the best effort and it's not their fault that they couldn't get the container out. It's up to the ocean carrier to prove that you should have had your box out and you didn't make the best effort to go get it out of there. Now, is that a good idea? Well, considering all of the errors that have occurred in detention and demurrage charges, it's probably a good idea to put the shoe on the other foot, at least for a little while, and then see if we can eventually come to a more equitable outcome. The FMC is also, the Federal Maritime Commission is also going to have some authority to set what the reasonable rates are for various fines, penalties, and demurrage, and nothing scares me more than that. I don't think it's a good idea to have a non-market entity determining what a market rate should be. There's got to be a better solution, and I would suspect what you should do is hire a number of experts. There are tons of people from the industry from both sides who have retired or serve as consultants, and they could easily sit on a committee that reviews and makes recommendations, trying to make sure that the system works fairly, rather than tilt the market power to one side or to the other.
Great, we've come up. It's really cocktail time now. So yes. I'm going to turn it over to Spencer for any final comments, and then we'll wrap up.
No, this has been incredibly informative, and thank you, Walter, for letting us pick your brain and sharing your insights. It's been incredibly helpful. So you're definitely the expert in the field, and we've all been really fortunate to have you share your thoughts today. So thank you.
Oh, thanks. Those are very kind words. And, who knows, maybe you have me back sometime and we'll see how things actually panned out.
Right. I think that's an offer for he just volunteered himself for another webinar. So.
Very, very good. Again, thanks. I'll just echo Spencer's comments. Great presentation, great comments. I think the folks today learned a lot from you, Walter. It's much appreciated.
That's great. Thanks so much.
Okay. So good night, everyone.
Take care.
Time to head to the refrigerator.
Okay. All right. Thanks, everyone.